This is Bloomberg Open Interest. I'm Matt Miller. Let's take a quick look at where stocks are trading. Right now, the S&P 500 unchanged, but you do see red arrows there on the NASDAQ, down just by a bit. The Russell 2000 by a bit more. A global IT outage has disrupted business and services from airlines to banks to the 911 emergency alert services. So that's something that we're still watching, and the effects on Microsoft, which is really at the center of these outages, and CrowdStrike, which in some ways has been blamed. Those outages have been fixed now, but it's going to take a while for the ripples to settle down. We have Abby Joseph Cohen with us, a Columbia Business School professor, retired Goldman Sachs partner, of course. And Abby, you know, we talk about the intersection between politics and the economy. Jason Furman, who used to run the Economic Council for President Obama, had a really interesting tweet yesterday outlining some announced economic policies that he thinks would be consequentially bad. And he orders them starting with 10% across the board tariffs, then $4.5 trillion of tax cuts, threatening the independence of the Fed, which you just brought up. It seems to me that that could be the worst of all, threatening the independence of the Fed. But I guess the reason that Jason only listed in spot number 3 is that it would be difficult to do.
There are a number of concerns that I would have about a change in policy. We talked, for example, earlier in the show about what happens if some of these long-term priorities are not properly funded, and that would be a lost opportunity for the U.S. economy to stay competitive and to continue to grow in a thoughtful way. In terms of the Fed independence, I am concerned because one candidate, and I'm not here to talk about politics, just policy, but one candidate has made it clear that he would like to interfere with FOMC policy. And in the past, when presidents have done that, it hasn't gone well. It tends to be highly inflationary because presidents like stimulation and stimulus to come from Fed policy. They don't necessarily want a measured, balanced approach. So I worry about that. I'm also very concerned about the discussions about tariffs, across-the-board tariffs. You know, there are some instances where a tariff makes sense. For example, if another country is dumping stuff in the United States, or in cases, and we've seen this in China, unfortunately, where they are manufacturing so much more than total global demand, that is something where a tariff may in fact be appropriate. But to have across-the-board tariffs are damaging to our economy because it's inflationary. It's damaging to other economies because it could hurt economic growth. We'd see particular impact on our friends in Asia, not just China, but our friends in Asia, and also our friends in Europe. And that to me is very concerning because it's something that could ultimately trigger a recessionary type of condition. We saw that in the 1930s, for example. I also worry about fiscal policy in general, but something that I have a somewhat contrary view on has to do with the focus on deregulation. There is a presumption on the part of many investors that deregulation is good for the economy, therefore good for the markets, and I disagree. I think good regulation is actually very helpful in terms of stimulating long-term economic growth. A free-for-all in industries is not a good idea. And I also worry about the Chevron deference, the Supreme Court decision that basically reversed that long-standing policy. What would happen under one of the candidates, because he's been talking about it, is to get rid of a whole level of experts in a variety of agencies, basically the scientific and engineering and technical experts, and replace them with political appointees. I don't see how complicated, complex industries, including technology, finance, energy, I don't see how they can perform as well as they have been performing if you take out that level of expertise.
Abby, I wish we can go longer. Those are some big thoughts about what 2025 could look like. We do have to leave it there. We are up against the clock. That is Abby Joseph Cohen of Columbia Business School. We thank you so much for your time. And coming up, we're going to talk about the bankers worldwide that have been caught up in this global IT outage. We're going to discuss that in our Wall Street Beat up next. This is Bloomberg.
On Bloomberg.
This is Bloomberg Open Interest. A quick check on the stock market right now. 24 minutes after the bells rang, you can see the S&P 500 pretty much flat on the day. The Nasdaq 100, big tech, starting to rebound a bit, of course, as it feels like industries across the globe grapple with outages. The Nasdaq 100 up about 0.1%. Small caps, we hardly knew you. The Russell 2000 down almost 2% right now. A pretty brutal end to what has been a great week for the small caps, Janali.
We were winning for a while there, Katie. You know, what goes up must come down, I guess. Well, we're going to go on to our top story today. For today's Wall Street Beat, bankers caught up in the global disruption, some unable to log on or make trades. Of course, guys, we're looking at firms from JP Morgan in Hong Kong to Balyasny in Singapore. Big companies. I will say a person familiar with the matter has said for JP Morgan, at least all branches will be online this today and throughout the weekend, but nonetheless, very disruptive.
Well, but the interesting thing is, or the important thing is, that everybody worked quickly to get things back. And of course, banks have fail safes, right? They don't just use one server system. They have others that they can go to. So while you could see an outage for an hour or two, they're very likely to get back on track.
Yeah, it's going to be interesting to see in like 3 months' time what the comments in the earnings calls could be, because as we heard, I mean, this will have some impact. A day matters.
Airlines, FedEx, bigger deal for companies outside the banks, but for the banks, the fact that the London Stock Exchange's news service being down, big deal if you were trying to get news out this morning.
Yeah, absolutely. Let's go get a look at what you should be watching for the rest of, for next week. New York Fed President Williams in the next hour, and Atlanta Fed President this afternoon. So that's today. U.S. executives will head to China next week to meet with officials following the country's third plenum. On Tuesday, we get big tech earnings from Tesla and Google. On Wednesday, Benjamin Netanyahu addresses the U.S. Congress, and on Thursday, we'll get U.S. GDP. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a major software crash disrupts travel, trading, and banking across the globe. And what could be the largest IT outage ever?
These disruptions adding to tech troubles at the end of a week that's seen the NASDAQ shed more than 3%.
Plus, Trump outlines his America First policies while pressure mounts on Biden to bow out. Let's take a look at these markets on this Friday morning. The S&P 500 right now clawing back, currently unchanged. The NASDAQ 100, same thing too, treading water there. We were lower, then we were higher. Now we're just about even. And then the 10-year yield, the Treasury market selling off a little bit, at least on the long end. You can see 10-year Treasury yields currently up about 4 basis points, Janali.
And back to that outage, computer systems at airlines, banks, and businesses around the globe have been disrupted after a botched update of cybersecurity program that CrowdStrike took down. Microsoft systems as well had issues. CrowdStrike CEO George Kurtz says a fix has been deployed. Separately, Microsoft also reported an apparently unrelated problem with its Azure cloud service. For more, we're joined by Ed Ludlow, co-host of Bloomberg Technology in San Francisco, and I think it was necessary to explain exactly here what happened, particularly because we had two companies with unrelated seemingly issues.
Yeah, I mean, the timing is somewhat curious, but the basics of it are that this only impacted Windows hosts. So in other words, if you were a corporate or consumer user of Mac OS or Linux out there around the world, you weren't impacted. And specifically what happened was CrowdStrike is pretty much the single biggest individual player in a market for what's called modern day endpoint protection. Think of it as like constant monitoring for ransomware threats. Old school archaic antivirus software would basically wait for your computer to show symptoms that you had some kind of malware or virus, and then it would respond. Endpoint protection constantly monitors, looks at data and signs, but in order to do that, it has to be granted direct access to your system. And so that's what happened. They did a faulty or corrupted patch of their software intended to improve ransomware protection. And the result was many, many Windows users around the world getting the dreaded blue screen. And as you guys have been talking about brilliantly, it's everything from the woman at the check-in desk on United. There's a really viral photo out there doing the rounds about somebody trying to help her hard reset the computer, to the banks, to infrastructure. It's astonishing, but it's not a hack. It's a cyber or IT outage.
Yeah, and of course that is important to remember here. But I am curious, I mean, what's the path forward here? We were talking about this with Mandeep Singh a little bit earlier. Even though this wasn't a cyber attack, it seems like this will be relatively short-lived. Do you think about the reputational impact for CrowdStrike? Could this allow some of its peers potentially to take some share?
Well, so CrowdStrike controls about a fifth of the market for endpoint. And the number two player, ironically, is Microsoft, who have their own problems with an apparently separate Azure outage. But the CrowdStrike product is also expensive. So if you think about the corporate context where a company has tens of thousands of employees and therefore computer users, not each one of them will necessarily be licensed for the product. It's about $50 per head. That means that only certain but likely mission critical computers were impacted. So the options are basically that the IT guy comes out of the office, runs down the hallway and helps you with a hard reset. But if you're a company of 10,000 and you've only got 5 IT guys, it's obviously going to take a while to do that if you're still waiting for the update or fix that's been issued by CrowdStrike to take effect. I mean, I don't mean to make light of it, but this is what we're talking about. You need to just kind of hard reset or reboot your Windows computer.
Ed Ludlow, as you know well, just turn it off and turn it back on again. Bloomberg Technology co-host Ed Ludlow talking to us about the great IT outage of 2024. Joining us now to talk about the markets, Kara Murphy, Kestra Investment Management Chief Investment Officer. And first of all, great to have you on the program. Thanks so much for joining us in studio. I think this really highlights a separate but parallel market issue, right? We have one outage with Microsoft Windows devices, and it stops airline travel globally. It makes it difficult in multiple states to call 911, and you can't put trades through. If we look back a week to, when the Biden administration floated the foreign direct product rule against some, chip makers, we saw just the stocks falling, and that pulled down the entire index, right? Do we have too much concentration in this market?
I actually love that parallel because I think it is very apt. We've had 18 months of the market being driven by a handful of names who are heavily levered to the semi sector, right? And earlier this week, we saw what happens when all of a sudden they stumble. And it wasn't a huge stumble, right? They still have great businesses, they have great earnings power, but I think the market has become overly reliant on just a handful of names. And in order for this market to remain healthy, for the bull market to continue, we have to see that start to broaden out. And we have seen that, obviously today notwithstanding. But I think this is very healthy for the market to not be totally reliant on a couple of names.
But then you think about the next couple of weeks. Of course, we're getting into the heart of tech earnings season in the next couple of weeks. And then, of course, we're going to see some of those smaller names report and have a chance to actually back up some of the stock performance that we saw this week. Do you think that they'll actually deliver the fundamentals needed to sustainably support that broadening out?
I think that'll be the $64,000 question. And so up to now, the tech names that have led this market have done so with tremendous earnings power. So this has not been on fumes. This is not like 2000 when you have names that are trading on eyeballs. Small caps, on the other hand, when we look at the earnings trajectory, has been much slower. That recovery has been much delayed. But I also think the market is going to give small caps a little bit more time for that earnings power to come through, simply because the valuation differential between smaller names and larger names is at historic wides. You don't have to be that much more optimistic to believe that these are good buys from here.
Well, then how do you pursue the rotation? Is part of this meaning taking profits off of those big tech names and adding them to value, adding them to small and mid caps?
I think on the margin, yes. So it's very hard to be able to time when the market starts to rotate. Certainly with this, the prospect of Fed rate cuts coming sooner, the market's starting to move on that. But what we see is even core indexes are so heavily reliant on large cap and growth that any opportunity to kind of diversify outside of that will help give you a little bit more balance in a portfolio. And mid caps in particular, I think, is a great way to kind of play that, where you have really strong businesses, good earnings growth, but you're not going so far downfield into small caps.
Do you need the Fed to get on a sustained cutting path for the earnings recovery, for the S&P 493 earnings recovery to be sustainable itself?
It doesn't hurt. Those names are much more heavily reliant on funding, right? They've been much more pressured with higher interest rates in general. And so certainly with those rates coming down, that's going to be a big tailwind.
They're coming down for now, right? Because the question around the election is, if Donald Trump puts tariffs on everything, if he cuts taxes drastically, if he, not only stops immigration at the border, but also deports 15 million workers, that could be really inflationary, and the Fed would then have to raise rates.
That might be then a different type of macroeconomic environment, but those things also take a while to play out. And we've been of the view in general that inflation is probably not going to be sustainably at 2% anyway, and that's okay. So the question is how much of an impact that has, and then how long it takes to actually take root.
I want to go back to the concept of the rotation. Like Shonali was saying, do you book profits on some of your big tech, put it into the small caps? Why wouldn't you just take it from cash? You think about $6 trillion.
If you have cash.
But $6 trillion is sitting in money market funds. And I think it's been interesting, the conversation around the rotation. It doesn't seem like it's a zero-sum game here.
I think that's a fair point. And we see a lot of people who are sort of sitting in those cash accounts because it's very comfortable. Like, why do I want to get out of that if I have 5% guaranteed? And there are a couple of reasons why. We think you have better opportunities longer term in riskier assets like equities. And I also think some of those numbers that look at, like, say, money market balances are a little skewed because for so long in a low interest rate environment, it didn't make sense to go into a money market. So not all of that is actually deployable into equity and bond markets.
Look at I just pulled up the MMFA index, the money market funds index.
Yeah, it's crazy.
It is shocking. I mean, to see that much money, and it's appreciated so quickly. We were looking at, less than $3.5 trillion in 2019, and then all of a sudden we go through this, great helicopter helicopter money handout of the pandemic, and we're looking at massive amounts.
How important, Kara, is the safety trade? You know, if you keep money in cash or buy gold or even, look to other places here to hedge this market, how are you thinking about that?
So it's been interesting, too, to watch Treasury markets because Treasury markets are still acting as a safe haven. I know they haven't felt like it over the last 2 years because we've had dismal performance. But what we're seeing is that as people start to get a little nervous, they still are looking to the Treasury market for that bit of safety. Gold, I think, has become another really interesting trade. We don't love it as a strategic asset class, but clearly people are using that as a way of hedging these different types of risks.
All right, Kara, it's great to speak with you. Really appreciate you taking time on a Friday. That, of course, is Kara Murphy of Kestra Investment Management. Let's get a look at what's moving underneath the hood right now. We're going to do that with Abigail Doolittle.
Well, of course, Katie, we have to take a look at these stocks that are affected or were a source of the global IT outage. So first, CrowdStrike, and it was their upgrade or changing around the technology on the Microsoft operating system Windows that created this outage. And you can see both of these shares down. Well, not so much. Microsoft is coming back from an almost 2% decline, but CrowdStrike is down 9%, well off of its lows. At one point overnight, it was down, or in early trading, it was down 21%. On the week, it is still down sharply, the worst week since November of 2022. As for some of the companies affected, McDonald's, those shares down 1.3%. They've suspended operations in 30% of their stores in Japan. The London Stock Exchange right now in London trading down about 0.75%. Their news feed was disrupted. And then, of course, airlines, that's where we're really hearing about the pain. 16,000 flights may have been affected. Both of these shares, American and Delta, are down. Let's take a look at the airlines most affected. This was a little bit surprising because United seemed to be the airline addressing it most quickly, but it actually, Delta, the flight cancellations the most, 477, followed by American United, Endeavor, and then KLM there. Lots happening on this Friday, and this global IT outage is certainly a big piece of the story.
Absolutely. Abigail Doolittle, thank you so much. Now, coming up, President Biden is facing unprecedented pressure to drop out of the 2024 race. We get the latest next. This is Bloomberg.
earnings season is here.
We're skating into another earnings season.
The expectation for earnings going forward are quite high.
Bloomberg is first to break the numbers.
Adobe earnings crossing earnings out of Broadcom.
JP Morgan, we get Citigroup, we get Wells Fargo.
There is something for everybody.
With the smartest insights.
Now banks have earnings power.
There's a resilience in the bigger cap companies.
We're not talking about a collapse in earnings for technology.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Let's get now to high interest to look at what's making headlines around the world. The Fed has been laying the groundwork for a rate cut in September amid growing confidence that price stability is within sight. However, San Francisco Fed President Mary Daly says some recent inflation data has been good, but we're not there yet. That's a direct quote. She flagged the need for policymakers to focus on both of their mandates. Former President Donald Trump used his nomination speech to take aim at President Biden's electric vehicle policies. Trump pledged to end policies that favor EVs on his first day in office. He also promised lower taxes and energy costs and an end to the illegal immigration crisis. Katie?
And staying on politics, NBC reported earlier that President Biden's family has started talking about a plan for him to exit the 2024 presidential race. But minutes later, a White House spokesman says that the report was wrong. For more, we're joined now by Anne-Marie Hordern, Bloomberg's chief political correspondent, the co-host of Bloomberg Surveillance. So a lot of mixed messages here, Anne-Marie. How important is this weekend?
Well, this weekend is critical for the president. He's getting even more politically isolated, and he's physically isolated in Delaware right now, and he had to stop short his campaigning this week to go self-isolate in Delaware. Why this NBC report is so interesting, because if there's anyone that's going to be able to convince the president to step aside, it's going to be members of his family. And this is what the report says. The overall tone of the conversations has been that any exit plan, should Biden decide to take that step, as some of his closest allies increasingly believe he will, should put the party in the best position to be former President Trump, while also being worthy of the more than 5 decades he has served the country in elected office, these people say. Now, we should note, the White House and the campaign firmly deny this. They say Biden is sticking in this race. Biden has come out and said the delegates are his. There have been gaps in explaining what could make him potentially step aside. ABC earlier this month, he sat down with George Stephanopoulos and he said the Lord Almighty would have to come down and convince him. At a NATO press conference I was at with the president, he said potentially if had hard data, if polls showed he could not beat Trump, he'd be convinced. And then most recently this week when he sat down with BET, he said if there was a medical condition that has emerged. So you do see some cracks in the president's reasoning. At the same time, the pressure mounting. This NBC report is citing a conversation with his own family, but this entire week it's been a drip of reports from the likes of Senator Schumer, Hakeem Jeffries, Nancy Pelosi, and former President Barack Obama saying they are concerned that he's going to lose this race.
Anne-Marie, I guess at the end of the day, why does it come down so much to his own family and his own decisions when you're hearing a growing chorus of Democratic senators and former very prominent officials really step up to the plate with their concerns here?
I think part of it is that Democrats have counted Joe Biden out in the past. Look at what happened in 2016. They really looked him over. He said he got out of the race because of the death of his son, but they went for Hillary Clinton. He's been counted out before in the past, in his personal life as well as in his political life. And he's been known as the comeback kid, and that is why everyone is saying this is so critical for him to make this decision on his own. But really, he's so close to his family, and he will make this a family decision. They talked about it, a number of times throughout his administration, whether or not he would seek re-election. As a family decision, they decided he will, and now it's going to come down to, his family and him himself making this decision, whether or not he decides to step aside. The most important individual surrounding him within his family, though, he has a lot of grandkids. Of course, he has his son, Hunter Biden, who we're now hearing is a part of more conversations, is his wife, Dr. Jill Biden, the First Lady. She is really his North Star, and if there's anyone that's going to help him make this decision, it's going to be her.
I encourage anyone at the Bloomberg terminal, Anne-Marie, to check out WSL space election on the terminal. You see, for example, the betting market odds. Predicted has a 27% chance that Kamala Harris wins the presidential election versus 62 for Donald Trump and only 12 for Joe Biden. What are you hearing about the vice president in terms of her readiness to campaign?
Well, you know, she has been on the campaign trail as well. One message she's been really focused on is a vulnerability in the Republicans. Donald Trump's speech last night, he hammered home two issues that are top of the pile for Republican voters: immigration and the economy, especially when he talks about inflation. One thing he did not mention, which part of his base want to see them talk about, is the fact that his Supreme Court, or justices that he was able to get on the Supreme Court, knocked down Roe v. Wade. And Kamala Harris has been out there campaigning on this, trying to get into the minds of independent voters why they should leave their couch November 5th and go vote for the Democratic ticket. So I imagine she is going to really want to lean in this message, because it's a vulnerability for the Republican Party, for those centrist individuals when it comes to abortion. Many think they're too extreme. When you look at some of the polling, when it comes to the economy and immigration, they say Trump would be a better president. When it comes to things like reproductive rights, they look to Joe Biden.
Well, Anne-Marie, you know better than most that the timing is very, very tight here. Of course, the DNC approaching in mid-August. Just walk us through what a potential timeline would actually look like here again.
It's honestly anyone's guess. It's a very gray area. It's uncharted territory. But what potentially I would say is the last final moment would likely have to be the day before the convention, unless they want absolute chaos on their screens, the Democratic Party, I mean, from networks being wall to wall on how this is contested, and they are very divided, deeply divided. That will be the takeaway if they don't have this shored up going into the Democratic National Convention kicking off in a month's time. So I would say that is really the do or die deadline. Of course, there's a little bit of this gray area as well with the fact that they want to bring up the roll call vote virtually. Depending if that goes through, we can see maybe where the balance is shifting within the Democratic Party. If they bring that up to August and Biden is able to hold on to that, it's going to be very challenging for someone to contest him at the convention. But if they push that back, potentially giving him more leeway to step aside closer to the convention.
Anne-Marie, thanks very much. Anne-Marie Horton there out of Milwaukee, where she spent the week at the Republican National Convention. Still ahead, we're going to take a look at the companies making the most social buzz today. Social Climbers is next. This is Bloomberg.
It's time now for Social Climbers. The company's making social waves this morning. And first up, it's dark times for SunPower. The solar company telling clients that it's pausing some operations and halting new product shipments. Guggenheim cut the firm's price target to 0, saying the stock is basically worthless and may soon be delisted. Next up, we have Hawaiian Electric among the companies that have tentatively agreed to pay over $4 billion to resolve hundreds of lawsuits over the wildfires that ripped through Maui last year. Now, if approved, the accord would settle suits on behalf of thousands of homeowners and businesses against the utility company. And finally, Apple is in talks to license more films from major Hollywood studios as it looks to boost its Apple TV Plus streaming service. Now, the tech giant licensed about 50 movies from Hollywood earlier this year, including classics such as Mean Girls and Titanic. But still a long ways to go. Just 11% of U.S. households subscribe to Apple TV Plus compared to about 55% of households that use Netflix. And you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. And guys, I have to say I'm a big Netflix user, but I did get Apple TV just to watch the morning show.
Favorite for me too. Watched it twice actually.
Really?
I did.
Yeah, it was too soap opera-ish for me. I need to have like spies involved or else I can't.
You need real life news with me and Katie in the morning is what you need.
Yeah, actually, you're enough of a morning show for me. So I think it's fascinating that only 11% of households subscribe to Apple TV. I would have thought they're much more successful because I imagine far more people than that use the Apple TV box in order to navigate.
And here's the thing, let's get serious about it too. You have Netflix, for example, coming out, really widening its lead over rivals, 8 million subscribers, beating on every single market around the world. But also on top of that, really touting the other things they do. Games, for example.
I never knew.
Who knew?
Apparently they have 100 games.
Yeah, I didn't know that either. I will say, I mean, you think about the streaming wars, it feels like we're talking about just a cohort of other companies. It's like Netflix, and then there's the streaming wars with everyone else. Again, just speaking to that dominance.
A lot of them are now introducing commercials, right? Hulu has interjected these commercials, and I guess there's a lower tier for Netflix as well. I can't sit through them.
I think you had a great comment that you made with a guest a little earlier about this idea that Warner Brothers, if they spin off that streaming service, can they actually compete? The funny thing is, we had Golden Tree Stephen Tannenbaum yesterday saying that he would invest in Warner Brother bonds if they saw this happening. So maybe it's a benefit for somebody.
Yeah, maybe for the bond investors, the equity holders. I don't know. It'd be interesting to see how they feel. Now, coming up, Sally Krawcheck says the tectonic plates of wealth management are shifting and that the future is female. We'll speak to the founder of Elvest next. This is Bloomberg. Well, Sally Krawcheck has over 25 years of experience on Wall Street. Now she's putting that knowledge to work, helping women build their own wealth. That's the goal behind Ellevest. It's a financial literacy and investment platform that she founded. And I am thrilled to say that Sally joins us now. Great to see you in person.
Hey, good to be here. Thanks for having me.
I was so drawn to a column that you wrote in the Financial Times in late May, talking about the coming feminization of wealth. And you talk about, again, those tectonic plates. And sort of to set up the conversation, if you could describe to us what you see in the offing, that would be very helpful.
Yeah, so we've all heard about the great wealth transfer, where the boomers have created the most wealth in history and the gentlemen are beginning to hit 79, 80. What happens when you hit 79 or 80 is you begin to die, and the money then goes, most folks talk about, to the next generation. But in fact, because women live 6 to 8 years longer than men, because half of marriages end in divorce, a lot of that money, and we can debate, is it $40 trillion, is it $20 trillion? Some people say $80 trillion, but it is a boatload of money is going to the spouses. And so what we are seeing beginning is what we call the feminization of wealth, where women are on their way to having the majority of wealth in this country, and very importantly, deal with and invest their wealth differently than men do.
So what does that mean for the investing landscape? Because you hear all the time in these sorts of conversations that women tend to be more risk averse when they invest.
It's their fault. It's their fault. They're so risk averse. They're not good at math. They need more financial education. They don't like to trade. It's their fault, right? This would be sarcasm because none of that is true.
Right.
And what we find at Ellevest is it's not that women are risk averse. It's that they're not buying what the industry is selling. That when that money comes into their hands, they typically leave their joint financial advisor, the one they had with their husband, at a rate of what can be 80 to 90% over the next year.
Amazing.
Only about a third of them, our research shows, know what to do, so they tend to put it in the bank. And so it's not something inherently wrong with women. It is the fact that the industry has been very male-dominated, and it is the fact that media has given women messages about the scarcity of wealth, about how they're buying too many lattes, about how they're having too many facials, and so women tend to retreat.
That point on the industry, I think, is really interesting and important here, because for all the amount of kind of, talk that the banks have had about more women in the workplace and serving more women as clients, you still see almost every major bank still has their head of wealth management as a man. And so do you believe that the workforce is broadening at this point?
Well, and there has been some progress made, and let's be very clear about that. But particularly amongst financial advisors, it's still 80+% men. And there's a lot of energy around it, but inertia is a very powerful force. If you are making a boku of money serving mostly white, middle-aged white men, why would you change? Why would you disrupt your business to make it different in order to serve women if they happen to be looking for different things? That's why instead of starting an Ellevest within a company, we started it from scratch.
I had a great talk with a venture capitalist friend of mine over the weekend, Jessie Draper, and she mentioned that female founders still only get 2% of venture capital. And that's a number that I heard, 10 years ago. When is that going to start to change?
Well, why does it have to change? First of all, Jessie's terrific, and they are an investor in Ellevest. And it's 2% for CEOs overall. Within fintech, it's something like $1 in every $10,000 women CEOs get. They get very few of them. When is it going to change? Does it have to change? Does it have to change? Just because it feels like that's unfair, it should change. When, venture funds are making a lot of money, there's innovation, why does it have to change? Where we see it changing is in the early stage, the seed, the Series A. You have wealthy women who are saying, I'm going to use this wealth that I've just received, and I'm going to invest in other women. So that's where the change is starting.
I do want to talk about how Ellevest fits into this coming wealth transfer, of course. When you think about what your platform is built to be, being a part of helping women invest, how do you build a business around that to actually capture and help accelerate that?
So we help women invest from their first dollar through a digital offering, the only one that takes gender into account, which matters if you're a woman and you earn less and you take more career breaks and your salary peaks sooner and you live longer. It matters, through to financial guidance and through to private wealth. And so we have clients who have everything from a few dollars with us to multiple tens of millions, serving them with financial advisors like the other wealth management businesses there. We find women tend to be particularly interested. I know that, ESG is a bad word now, but women are like, no, I understand that every dollar I invest has an impact, and I want to know what that impact is. And whether you call it ESG, whether you call it impact investing, whatever you call it, I want to know the impact my money is having, and I want to make a positive impact.
Sally, what is the biggest question you get from women who are looking to stop putting their money in the bank and start putting their money to work?
Where should I start? How much should I start with? We also see from a lot of women sometimes guilt about it, guilt about leaving an existing financial advisor. We say the fine financial advisor. If someone says they've been fined for years, they lost me a few $100,000 by overtrading, but I don't want to hurt their feelings. And so because women have been socialized to take care of everyone else, we sometimes see they're reluctant to leave others. But then it's, how much do I need to know? My friend Reshma Sojani says that boys were taught to be brave and girls were taught to be perfect. And so what we see among women is, do I have to know this entire encyclopedia of investing terms before I start, or can I start by only knowing half of the investing terms? And so learning that you're not going to know it all, finding someone you trust, and beginning that journey of investing is the key.
It reminds me, of course, of imposter syndrome, and that's a whole different conversation. But before we let you go, I do want to talk a little bit about generational divides as well, because you mentioned financial advisors, of course. And I'm wondering, for younger investors, maybe investors and particularly women investors who are starting their investing journey, are financial advisors still relevant?
Financial advice is still relevant. Finfluencers are scary because they are incredibly entertaining to watch, but those who are most entertaining, I think I saw research, are the most likely to underperform. And so they're sort of driving an active management, cutesy, funsy sort of thing, which worries me. The key is, look, get started early, a bit out of every paycheck, a diversified investment portfolio. Don't try to actively trade, but time, as I don't have to tell y'all, because of the power of compounding, time is your friend. So it's never too early, but it's also never too late. For those women we see who are in their 40s, 50s, oh my gosh, I didn't get started in time. It's time to start now.
Sally, have to leave it there. Really enjoyed this conversation. Hope to see you again soon. That, of course, is Sally Krawcheck of Ellevest. Let's get a check on these markets. We're going to do that with Bloomberg's Abigail Doolittle.
Well, we are looking at session lows on the day for the NASDAQ 100 relative to the futures overnight. And you can see the NASDAQ 100, after a pretty rough week, overnight during the Asian session had been higher, but then amid the global IT outage, a dip lower, and now we're back down toward those levels, down about 0.5%. We're looking at a second down week in a row for the NASDAQ 100, down more than 3%. Its worst stretch since April. Relative to the rest of the markets on the week, let's take a look at what is going on, because we do have the S&P 500 also heading to a down week, down 1.5%. It is a risk-off week. Take a look at the VIX, and we'll be taking a closer look at the VIX in just a moment, but above a 16 handle, the 10-year yield, on the other hand, higher. So there's not a bid for bonds. So there is a bit of an interesting contradiction there, but this could certainly be pressing on stocks as well, along with that rising yen. And then the Bloomberg Dollar Index up 0.4%, which is interesting given that action in the yen. As for the VIX, let's take a closer look, because this is really, really interesting what is happening here. And this is actually a chart of NVIDIA, the VIX, that curve steepening above a 16 handle on the uncertainty. But this chart's actually much more interesting, I would argue. So thank you to the control room for getting it in here at the last minute, because NVIDIA has started to turn lower. Right now, it is at a really critical level. It's at 119. If it goes below 118, which would basically set this topping pattern into motion, this gap down here below 100 would likely fill. Right now, just hovering above that 50-day moving average. You can see the RSI, or momentum, continuing to go down, suggesting that NVIDIA at some point, whether it's today or next week or the week after, is very much likely to go through that 118 level. If that happens, that could really, as the third biggest weighting to the S&P 500 and the NASDAQ 100, Katie, have a big move on markets, and also from a sentiment standpoint, as has been the case this week.
All right, Bloomberg's Abigail Doolittle. Thank you so much. Now, coming up, a return to office hasn't solved all of commercial real estate's problems. Boston Properties CEO Owen Thomas tells us why perception is worse than reality. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And commercial real estate's rough patch might not be over yet. Boston Properties CEO Owen Thomas told Bloomberg's David Weston what's affecting the recovery.
It has been a rough time. I always say, though, perception is worse than reality. And commercial real estate is bouncing back, defined as office. There are two external drivers that really drive the office business, certainly the business of BXP. One is interest rates, and the other is corporate earnings growth. I think the interest rate story is pretty obvious. Real estate stocks, real estate are primarily a financial asset, and if the cost of capital is lower, those assets are worth more. We had a very favorable inflation report last week, and since that came out, and with the prospect of more rate cuts and the fact that the 10-year now is below 4.2%, it's really escalated our stock price over the last week. The second important driver is corporate earnings growth, because that drives leasing. In 2023, the S&P 500 earnings growth was flat, 0. In 2022, it was very tepid. But here in 2024, in the first quarter, it was up 8%, and this quarter is predicted to be even higher. So when companies are profitable and they're making money and they're growing their earnings, they're more likely to grow, hire people, and take more space. And we're seeing that in our leasing activity. In the first quarter, at BXP, the square footage that we leased was up 30% from the first quarter of 23. And in the second quarter, we're seeing continued escalation, both in terms of signed leases and our pipeline for future quarters.
Up 30%, but is that off of a low base?
It was off a low base, yeah, because we went through, as interest rates went up in 2022 and 2023, as I mentioned, corporate earnings growth slowed way down. And when that happens, companies aren't growing. They're thinking about ways to cut costs. And we saw that. A lot of sublease space got put in the market. There wasn't a lot of new requirements in the market. But now that the environment around corporate earnings is improving, it's improving our leasing because companies are growing again.
So strong corporate earnings make it a little easier to hire more people, as you say.
Yes.
You have to actually get the people into the office.
Yes, that's true too. That's true too.
How's that going? How's return to office going?
Yeah, I do think there's no question that work from home has an impact on office demand. I do think in the premium sector where we operate, it's a little bit less so because the clients that we have generally want their employees to be in the office many days per week. But in terms of what we actually see, BXP manages today about 54 million square feet, and we have badge data on about 50% of that space. And so what we're seeing today versus the last quarter before the pandemic is in New York, Tuesday to Thursday, on buildings that are comparably leased, the visitation is the same. So in other words, the badge swipes haven't diminished at all. So Tuesday to Thursday, New York is back. And Monday is coming up slowly, and Friday's very slow. I mean, by the way, Friday was slowing down before the pandemic, but it's definitely slower today. So that number in Boston is about 80%, also rising. So Boston is also improving Tuesday to Thursday. And then San Francisco lags. It's at 52%. But again, that is slowly improving. And the other thing that we see in the data is that if you look at the unique weekly visits of a worker, that gap between the East and the West Coast is less. However, those individuals are coming into the office fewer days per week on the West Coast than they are in New York or Boston.
When it comes to the stock market, it's been driven so much this year by that so-called Magnificent Seven,
yes,
which seems to be a lot of it related to artificial intelligence.
Yes.
Is that spilling over into the commercial real estate market?
It is. It is. So if you look overall in space demand today, I actually would say the technology companies is the biggest gap. We see most of the demand today coming from financial services companies, law firms, professional service firms, and the technology companies are not leasing space at nearly the level that they were before during the pandemic, primarily driven by the large tech companies. However, in San Francisco, to your point, David, there are a number of AI companies, small startups and medium-sized companies that are taking space. I think the net absorption from those companies over the last year or 18 months has been about 2 to 3 million square feet. And also, interestingly, those workers are in the office, I think in many cases up to 5 days a week.
So that's sort of on the demand side for the office space. What on the supply side in terms of financing?
Yeah.
Where are we on available financing right now for commercial real estate?
Yeah. Well, before I get into the financing on the supply side, I would say new construction is obviously coming way down because today construction costs have elevated so much and rents haven't kept up. So it's very difficult to justify new construction because not only have hard costs gone up, but also the financing costs. So that's going to be helpful.
And that was Owen Thomas of Boston Properties with Wall Street Week's David Weston. And coming up tonight on Wall Street Week, we hear from Bank of America's CEO Brian Moynihan, former Fed Governor Dan Tarullo, and economist Laura Tyson. That's at 6 p.m. Eastern. Now, we do want to bring you an update, of course, on those outages that we've been seeing. This, of course, comes from the Microsoft 365 status on X, saying that we've completed our mitigation actions and our telemetry indicates that all previously impacted Microsoft 365 apps and services have recovered. They're entering a period of monitoring to ensure that impact is fully resolved. So the cleanup, of course, is underway.
Yeah, you still have Microsoft shares down about 0.3%, moderating those losses. CrowdStrike still down more than 8%, also moderating losses, however. And, you know, honestly, for CrowdStrike, you're looking at really only the worst day intraday since May.
Well, did you see that Dan Ives note saying that longer term, I mean, CrowdStrike is still a positive story, so.
Dan Ives says that he's still bullish on that.
He is
that
still
company.
bullish.
Okay.
Surprise.
Yes.
Dan Ives is still bullish.
He's a very big bull, and he's been right.
Here's the thing. On critical infrastructure, what are you going to do? Right? I mean, these are the companies that lay the pipelines for the internet, and it is what it is.
It is what it is, of course. The league table's hard to unseat there. Much more coverage coming up. This is Bloomberg.
Let's get to the trading diary, what you need to be watching today and next week. Today, we're going to hear from Atlanta Fed President, the Atlanta Fed President this afternoon. There you see Raphael Bostic. U.S. executives will head to China next week to meet with officials following the country's third plenum. That only happens twice a decade. On Tuesday, we get big tech earnings from Tesla and Google. And then on Wednesday, Israeli Prime Minister Benjamin Netanyahu will address the U.S. Congress. Thursday, we get U.S. GDP, followed by PCE, so inflation data. data on Friday.
All right, it's time now for ETF Friday, and I want to talk about equity ETFs because generally they account for about 30% of all exchange volume, but something interesting is happening this year. That share is well below the average, some days only hitting 14% or so. Let's get to Eric Balchunas right now. He is ETF analyst for Bloomberg Intelligence. Eric, what does this mean? Because I thought ETFs were taking over everything.
Yeah, no, I mean, if you're somebody worried about that, this is a good sign. In fact, I think it's a good sign. You don't want ETFs to trade, that much. If you look at as you said, the average is about 27%. So ETF volume would be 27% and equity actual stocks would be the rest. Now it's down to 14% on some days. So it's been very low. The reason is simple. Nobody has any fear. Because a lot of that volume, a lot of the reason it goes up to sometimes 25, 30, even 40%, especially on crazy days, is that SPY, IWM, and the Qs are so liquid that institutions use them sort of like a moat around the portfolio. That's the first thing they use to tweak their position. So when there's fear, you see volume in SPY and the Qs and those big liquid ones really shoot up. And that shoots the whole number up. And so I think, if anything, this is just a sign that everybody's very calm and there's really no fear in the market. And also I will say and the NVIDIA is a little bit of an outlier. That's trading more than SPY lately. So I do think the NVIDIA effect is part of this. People love trading that stock.
Well, to that point, of course, the Eric Balchunas view is that this means that there's not a lot of fear in this market. The Athanasio Serafakis view of Bloomberg Intelligence says that this means that people are just picking stocks more. I mean, how much water does that theory
That's
hold?
more fun, Eric.
Yeah.
Yeah, we're trying to give people hope. We're writing about the rise of passive, and it can be depressing for active managers. But no, the truth is stock picking is alive and well. There's also a lot of ETFs that do stock picking, and there's single stock ETFs now. But I think when you have a market like this where, there's opportunity to outperform, like if you had invested in NVIDIA, even overweighted a little, you're doing better. I think there are opportunities out there. And the fact that stock trading is alive and well is very important because ETFs are only going to work if the underlying is liquid. I mean, that's part of the secret sauce of why ETFs work well. So I love to see it. You want people picking stocks if you are an ETF fan.
Can you talk a little bit about the flows? Eric, anyone that watches you online shares your excitement about where the flows are actually going. And what did this week tell you?
Small caps finally woke up. IWM and RSP are both made the top 5. Those are the same trade. As my colleague and manager Gina Martin Adams puts it, the 493. The stocks that aren't the Magnificent Seven finally had a good run. So that would be equal weighting S&P, which is RSP. That's been hot. And also IWM. IWM actually traded more than the Qs, which hasn't happened since 2017. That was a couple days ago. Now, I saw IWM had a bad day, and I do wonder how long these rallies can last. A couple days of small caps. Can we get like a regime change for real? I'm skeptical. We've seen this movie before. Seems like large caps always take over after a couple weeks or months. We'll see, but certainly breadth in the market, we think it'll be really good for ETF flows overall because the money's still going into the large cap growth.
Right.
But if the other guys can, start catching fire, that's going to be good for basically everybody.
All right, Eric Balchunas of Bloomberg Intelligence. I'll see you on Monday because that's when ETF IQ is, every Monday at 12 p.m. Eastern. Now, coming up next week on Open Interest, Charles Myers of Signum Global, Ann Walsh of Guggenheim, and much more. This is Bloomberg.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, full coverage of the massive IT failure that has grounded flights and upended businesses and markets.
And Netflix gets its mojo back. Strong subscriber growth extends its lead on streaming rivals.
And in an exclusive interview, Mark Zuckerberg calls Trump a badass without endorsing him for president. More on politics and tech ahead, but first, the market ramifications of the IT issues that have hit across from Asia to Europe to the US. And it was during European and Asian trading that we hit the hardest. I'm looking at the NASDAQ futures therefore, Ed, because actually we're only trading off by about 0.3% on the major benchmarks, but we did hit our lows at about 5 a.m. That was when we really started to worry about the global ramifications of one key company, Ed, that you're watching.
Yeah, and it's CrowdStrike, and CrowdStrike is down big. A market leader in endpoint ransomware security put out a faulty patch or update, and that impacted Windows hosts around the world. Didn't impact Mac OS, didn't impact Linux, if you're in that camp. But separately, coincidentally, there was also a Microsoft Azure outage. Both of those contributing to the downside in Microsoft stock. We have a number of updates. There have been fixes issued, but so many of you have reached out to Kara and I on social media to say, yeah, turning the computer on and off 15 times seems to have worked.
Blue screen of death, as it was known, throughout any airport that you're unfortunately stuck at. But we want to take a closer look at what is seemingly a botched CrowdStrike update that has caused this massive IT outage. As Ed says, disrupting Microsoft, global airlines, banks, healthcare systems were hit hard by what is said to have been one of the few outages of this scale. It's global in nature. Who do we bring on? Our own Tom Giles for the team leading perspective here. I mean, we had a very busy set of teams across Asia and Europe today.
It's great to be here. Thanks for having me. Yeah, massive outage, unprecedented in its scale in many, many ways. As Ed so succinctly summarized, there was this upgrade to CrowdStrike software. This is a cybersecurity team that many companies around the world, many businesses, many government agencies rely upon to monitor their systems and keep the intrusions out. There was an upgrade and it affected Windows systems around the world, and chaos has ensued.
Okay, so Windows is the operating system designed and operated by Microsoft. Separately, there was a Microsoft Azure or cloud outage, which has confused things. This is the latest from Microsoft 365, basically saying that it appears Microsoft 360 apps, normal services have recovered. Again, there is ongoing issues. I mean, all you have to do, Tom, is go on social media and see the images of the dreaded blue screen that Caroline brought up. What also is interesting is how widespread industries were hit. Airlines, banks. What's our coverage telling us about that, the global nature of the disruption?
Banks, UPS, so deliveries are disrupted, flights around the world. What this shows is the fragility of our global systems that are so reliant upon single vendors, and one particular patch can send things awry. And when you combine that with the ubiquity of Windows machines, they run something to the tune of 70% of the computers around the world. And then you, on top of that, add Azure, this cloud computing system that many companies, many businesses around the world rely upon for their cloud systems. This really put together a toxic cocktail of IT outages everywhere. And it just shows how vulnerable our systems are to these single vendors.
Bloomberg's Tom Giles, Senior Executive Editor, leading our global coverage of technology. Later in the show, I promise we're actually going to get a little deeper on what endpoint security is. We have a brilliant technical guest, but the market reaction, let's talk about that and bring in Jordan Klein, tech media and telecom analyst at Mizuho, desk analyst. And my goodness, your phone must have been ringing off the hook this morning. What have investors basically been telling you about their concern or lack of concern?
Well, good afternoon, Ed. Thanks for having me. I think clearly people are reacting this way because CrowdStrike is probably one of the most owned and liked companies in the software sector. It's up almost 35-40% this year. There's very few companies in software that are up that much. And when you have one of these events, which thankfully wasn't a hack, it was an outage, and there's a huge difference, reputationally for the company. But when you have 2 weeks left in your quarter, they're a July ending second quarter, it makes people extra nervous that any disruption or problems closing business with new customers to make their estimates or their guidance could be at risk. And right now we're in a position where investors are looking for reason to sell tech and rotate into other lagging areas. And I think they're kind of using this to take risk off and, not worry whether this impacts their quarter.
Jordan, I don't know how well versed you are in the market for endpoint security, but the IDC data shows that CrowdStrike has about a fifth of the market. Ironically, the number 2 in that market in terms of individual players is Microsoft. Both of them under pressure. How do you play that?
Well, I think that's a good question. I don't really think that you play that in the view that one is going to lose a bunch of share or they both will. Because it's a outage and it's not a hack, that to me suggests you're not going to see a bunch of customers moving off of CrowdStrike or even Microsoft. Some people are, bidding up shares of SentinelOne. That's a stock that competes at endpoint with CrowdStrike, but I don't even know where they rank in the top, market share listings. Palo Alto is another, big competitor. They don't necessarily do all endpoint, but they do firewalls and cloud security, and that stock is gaining because people, I guess, assume they'll benefit. So at the end of the day, we'll have to wait and see what the implications or ramifications are. But I would advise investors, don't make any quick, snap, knee-jerk reactions in terms of buying or selling. And I'm more of a net buyer on this weakness as it relates to CrowdStrike. I think they'll come through fine in a couple of weeks. People won't even be talking about this.
This is a big market cap impact, Jordan. What's interesting in your note is you bring up, look, are they on the hook financially in any way? How will we understand that from CrowdStrike as to whether or not their own clients either put off renewing or say, look, I lost a lot of business here, where's the money?
Yeah, that's a great question. I've talked to some people. We put out a quick research update from Mizuho research analysts. What I think is going to happen is you're not going to hear anything until they report their quarter. And that won't come until the quarter closes after the end of July. So it could be as much as a month until you don't really get an official update as to what they're liable for, if anything. We do not think their contracts are written such that they'll have to, basically pay these companies for lost business or revenue. But what's probably going to happen is to appease companies that were disrupted, they will give credits, meaning they will say, you're under contract and you owe us money, but we will give you a credit for business that you owe us under the contract. So it's basically a discount. How much, we don't know. But as soon as they can quantify that, I think the markets will like the clarity and they'll be more positively disposed once they can quantify what the impact will be. And I wouldn't imagine it's going to be any massive amount.
And to that point, when you've got a $6 billion move on a market cap, maybe it's not as big as $6 billion. Maybe you can buy into some of this weakness, Jordan, that you're speaking of. How many people do you think, though, in this current environment of jitteriness, are willing to go long into a weekend such as this?
We're going to find out as the market, we go into the afternoon and we see how this stock trades. I would say initially, it's 11 o'clock Eastern. I'm pretty encouraged by the way the stock's acting, given it's well off the lows. If this was something where people were in an absolute panic and and the market was melting down, I think it would be at the lows, and it's not. So I wouldn't be surprised if it continues to grind a bit higher. But I do think, again, the sentiment in tech broadly is people are nervous. The sector is not acting well. It's particularly nerve-wracking for those as we wait for earnings. And I kind of feel like most investors are going to take a wait and see. Our volumes on our trading desk don't suggest panic selling, but it doesn't suggest you're seeing waves of buyers coming in after a few days of weakness either.
Jordan Klein, perfect voice for today. We thank you, tech media and telecom analyst at Mizuho. Appreciate the time. Now, let's just talk about Meta CEO and founder Mark Zuckerberg weighing in on the current election landscape in an interview with Bloomberg Originals host Emily Chang for an episode of The Circuit. Just take a listen.
The main thing that I hear from people is that they actually want to see less political content on our services because they come to our services to connect with people. So, that's what we're going to do, where we give people control over this, but we're generally trying to recommend less political content. So I think you're going to see our services play less of a role in this election than they have in the past.
Watch the full exclusive interview with Meta CEO Mark Zuckerberg on The Circuit with Emily Chang. It's July 23rd, 6:30 p.m. in New York on Bloomberg Television, or stream it 8:30 p.m. ET on Bloomberg Originals. I'm so pleased he wore the gold chain. Meanwhile, coming up, we'll be joined by Needham analyst Laura Martin to break down Netflix's second quarter results. This is Bloomberg Technology.
In terms of that member growth and churn, I'd say that the kind of outsized paid net adds in the quarter was primarily driven by stronger acquisition, a little stronger than we expected, but also very healthy, continued healthy retention in the quarter, and that's across all regions.
That was the Netflix CFO there, talking about the company's member or subscriber growth and retention. Earnings showed strong subscriber additions in the second quarter. I want to bring in Needham Senior Entertainment and Internet Analyst Laura Martin. It's a situation where after hours stock go down, market open, stock go up, good subscriber numbers, concerning guidance. Which is more important for you, Laura?
I think the subscriber number is in focus in both periods. So they over-delivered. They added 8 million subscribers. That was about twice the consensus. But then they had a very anemic subscriber growth number for the third quarter, and they talked about a tougher second half. So the answer is subscribers matter a lot. but subscribers like overall. And also the location of the subscribers is sort of suboptimal.
Yeah.
They're adding subscribers in the lowest ARPU, or what they call ARM, average revenue per user. And so that's actually, Wall Street doesn't like that either. And the biggest problem is they're going to stop giving us subscriber guidance and actually ARPU guidance in the first quarter of next year, and they just want to talk about revenue. And that's a really big problem because it's going to add volatility to the stock.
Where the subscribers are, I find so interesting as well. So they talked about strength in Asia Pacific, and then in terms or context of the guidance, like currency impacts, particularly in Argentina, if you're covering this stock, where do you want to see subscriber growth?
$16 ARPUs in America, you want to see them all there because it's like 2x. They pay twice as much in America compared to LATAM or APAC.
Okay, so you want more expensive money being taken in from the more expensive clientele, but ultimately are they going to get that at the moment, Laura? Are we saturated? We're still trying to discern which streaming service I want to be using and which one should be merging.
Yep. Well, and I really like I think the reason their churn is falling, like in America, they're saturated, as you say, is live. I think when they do these live fights and these live roasts and these exclusive live programming, it keeps people paying for the next month, because they really market these things, these exclusive live events. So I really I think their video game and advertising is very troubled here. Video games troubled, but I think live is a really interesting genre for Netflix to lower churn.
Okay, so they need to be investing basically, because that takes a Herculean effort from a technological perspective, right?
Yeah, and they're paying for NFL games, so they're joining the arms race in really expensive live sports programming. So that isn't great for your content budget. Look ahead.
Laura, we could go on and on about this entire environment, and we didn't even get to some of the discussion around the M&A today as well. Needham Senior Entertainment and Internet Analyst Laura Martin, always so spot on when it comes to this market analysis. Meanwhile, and we just want to turn our attention to another earnings today. Many would say at a large fintech, American Express, that the stock trading, well, it's been a bumpy ride today, in fact, currently off by more than 4% as the company sees fiscal year earnings per share between $13.30 and $13.80. And that actually was looking pretty strong, but it's warning that it plans to increase its spending on marketing in the coming months. CEO Steve Scurry telling me earlier today that they're really committed to marketing, to tech investments, particularly in artificial intelligence at the moment. Look, this is a company that has had record revenue overall, but the market's still questioning perhaps how they continue to be beefing up on the profitability side. Like many other American specs, has also been seeing an impact due to the CrowdStrike outage, saying, quote, "We had a slowdown early on. All airports were impacted, so our call logs were very high as people try to change their flights." So the CEO telling us that at the moment, though, still pretty confident. Ed, what have we got coming up?
Another big name in the world of software, Salesforce announced the launch of the Einstein Service Agent, their first fully autonomous AI agent for customer support. Salesforce AI CEO Clara Shih joining us next. This is Bloomberg Technology.
Okay, it's the growing field of AI. Salesforce recently announcing the launch of their Einstein Service Agent. This is the company's first fully autonomous AI agent working to transform, customer service jobs. Let's bring in Clara Shai, CEO of Salesforce AI, for more. Clara, how can you quantify the difference of a normal, typical chatbot here? How much better is this agent you're offering?
Thank you so much for having me. We've all interacted with customer support chatbots, and what they can do is pretty limited. It's always obvious that you're talking with a bot. Einstein Service Agent is our new offering that completely redefines the self-service experience. It really feels like you're chatting with a human expert who can answer complex questions and take complicated actions. For example, looking up an order, reviewing a photo that you've chatted in of a damaged product, issuing a return shipping label, sending a replacement, multi-steps, all in a secure and trusted way because Einstein is grounded in your company's trusted data, policies, and procedures in your Salesforce CRM.
There's a multimodal element to this. How much have you been building the large language models yourself, depending on others? Where does ultimately this agent come from?
Well, we've been developing large language models since 2018. We acquired a company called MetaMind, and our Salesforce research group, they are one of the most prolific publishers of frontier research. That being said, we believe in an open architecture because we want to give customers choice when it comes to AI models. We recently launched our CRM leaderboard. It's the first LLM leaderboard specifically for sales, service, marketing, and commerce. And we found something amazing, which is first that small models, in some cases open source models, actually outperform the biggest, most expensive models on the market when it comes to a lot of enterprise tasks. The second thing that we learned is that the leaderboard is constantly changing week over week. And so we really feel it's important to support an open, vibrant ecosystem of models.
Clara, good morning. It's Ed in San Francisco. Look, our lead story is the global outage, CrowdStrike, Microsoft. There's some 365 integration with different Salesforce platforms and offerings and your role across AI, but also cloud. What has the impact been on you and Salesforce and what's the response been, please?
I have a number of friends who are stuck in the airport right now. I think nearly every industry around the world has been affected, Salesforce included, by the CrowdStrike issue. Our engineers are working with the CrowdStrike team around the clock to restore full access to our services.
And just finally on that topic, you've long been in technology. How does this event rank, in sort of technological disruption or outages you've seen in your career?
I think there's that's an inevitability when it comes to technology, and it really underscores the importance of working with trusted partners. I mean, trust is Salesforce's number one value, and we very much pride ourselves in our uptime, partnering with many customers, specifically in AI, AAA, Air India, OpenTable. These are companies that really help run the world, and so we take that trust, security, reliability, and performance very seriously.
Clara, there's going to be quite a few friends of yours at airports and many others who are desperately trying to get hold of a real person right now on the phone rather than a chatbot. And I'm wondering how long that will be inevitable. You, in many ways, do transfer conversations with this new AI agent to a human if perhaps it just gets out of the capability of the agent. How often is that likely to happen, do you think?
Well, I think that it really depends on, the nature of how much knowledge and trusted policies and procedures the companies have been documented inside of their organization. And if they don't have very much, we're going to help them with that AI-generated, AI-drafted knowledge creation. But I think by and large, we're going to see more and more, just like when you're talking to a chatbot or just talking to ChatGPT, sometimes it's hard to tell that it's not a human. Now, the challenge is that without that contextual data and without those guardrails, these LLMs can just make things up. They can hallucinate. And so that's really where Salesforce's Einstein Trust Layer, that's the layer that every single AI interaction goes through before it gets presented to a customer. That's so important to make sure that it's trusted, reliable, and accurate.
Clara, our audience has kind of followed the rollout of what Einstein is doing and what Salesforce has done in the domain of sort of generative AI tool quite closely. You must benchmark against other similar platforms or products. What have you learned about performance, essentially, against what else is out there?
Well, it's such a great question. It's something that we're constantly benchmarking. I mentioned our CRM large language model leaderboard earlier. And we found that, there's really 3 critical ingredients to success when it comes to enterprise AI. First and foremost is trust. Making sure that you have data privacy, data security, ethical guardrails built in. Again, this is our Einstein trust layer, everything from citations to audit trails to observability, monitoring, and data masking. The second ingredient is having the right context. If you don't give the LLM enough context, it'll just make things up. Now, you think about our customers, they've been putting their trusted data and their trusted business processes, policies, and procedures into Salesforce for the last 25 years. And with the introduction of our Data Cloud product, now we have that trusted data across the entire enterprise of siloed systems. We're bringing that together. And so that context is critical to accuracy, reliability, and really the usefulness of the AI. And then the third ingredient is empowerment and helping bring every employee at an organization along for this AI learning journey, which is never ending. And I'm really proud of the work that we've done with Trailhead. We've open sourced all of the courses that we developed for our internal employees to get smart on AI.
Clara Shai, CEO of Salesforce AI, great to have you back on the show. Thank you. Coming up, we're going to get back to that massive IT outage around the world and disruption in all sorts of industries with a key name and an expert.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. It's Friday, but it's kind of red on the screen and a negative vibe. Actually, declines on the NASDAQ 100 have kind of accelerated in the last 20 minutes or so. The top story, you know what it is, the global IT outage. Many of you are either at home or in your office trying to deal with the dreaded blue screen. CrowdStrike is down 8.5%, off session lows. A point that Jordan Robinson of Mizuho made earlier, or Jordan Klein, sorry, of Mizuho made earlier, is that in terms of volumes trading, this doesn't suggest panic selling. There aren't buyers coming in either, Caro. Microsoft softer 0.6%. Windows is a Microsoft product, but separately from the outage, there was some issue with Azure, which they've also resolved, but the timing of which is kind of curious and kind of ruled markets as well.
Let's dig into it. Mandeep Singh, perfect person to be with us, Bloomberg Intelligence. And look, we were just having John Klein and Mizuho saying, look, but perhaps buy into this weakness rather than sell on CrowdStrike. Where do you sit on it?
No, I'm in the camp where I think this is going to linger on for a while, especially because the recovery is not as easy as just rolling back the software. I mean, there are a number of clients who are at an older version of Windows where you can't just roll back the code like this. And that's the biggest risk with cloud software, is it gets deployed overnight and it can have a far-reaching impact. But in this case, as we can see, the recovery isn't, in a minute or in an hour. So that's where this is going to linger on. And the fact that Microsoft is involved, they're the two biggest rivals when it comes to endpoint security. So in this case, who takes the blame? I mean, I imagine there will be lawsuits. There will be customers asking for indemnification because of the lost business. And who pays who? I mean, I think CrowdStrike will have to give a lot of discounts to their customers, credits, and that will have an impact on the free cash flow. So I'm just not ready to write it off as an incident that happened and move on.
The IDC data, I think, puts CrowdStrike as holding about 1/5 of the endpoint security market. I guess the basic question is whether this hurts their bookings, right? If there are customers or would-be customers that say, nah, I'm not going to go into CrowdStrike. What do you think, Mandeep?
I mean, so think of the endpoint security space on the enterprise side. It's 4 companies that dominate, CrowdStrike and Microsoft, and then you have SentinelOne and Wiz Security, which Google is rumored to express interest in. So clearly, you don't have a lot of choices to go to, but I do expect, customers asking CrowdStrike more questions, and that also brings into question the concept around agentless versus agent-based security. I think there will be a growing preference towards agentless securities where it doesn't change the underlying operating system behavior. So clearly, a lot of architectural level questions surface because of this outage, but I still think it's going to hurt CrowdStrike in the near term.
Mandeep Singh of Bloomberg Intelligence. Busy morning for you. Thank you very much. Let's keep the conversation going. Let's get technical and let's get some expertise with Steve Grobman, Executive Vice President and Chief Technology Officer at McAfee. And Steve, bear with me, but just for our audience's sake, CrowdStrike, founded 2012 by alumni, essentially, of the current form of your business that has a complicated history of its own. To start with, has anyone from CrowdStrike phoned you or asked you guys for help or advice on what's going on?
Yeah, I know the CrowdStrike team well. The cybersecurity industry is a close-knit bunch. They're running the response on this. We're really focused on making sure that our customers are well informed. McAfee is now a pure play consumer company where we're protecting consumers, and we're making sure that they understand that even though their devices are protected by McAfee, if they're using services from organizations or businesses that depend on CrowdStrike and were impacted by this event, that they might see things like banks or transportation having degraded service. And that's really where we're trying to play a role here, is to help our customers, our consumers, the industry navigate this.
Steve, a few people in the technology industry shared with me an email that CrowdStrike support sent them, and I'm summarizing or paraphrasing, but the email basically says reboot up to 15 times, and that should do the trick. What do you make of that?
When there are issues, putting together procedures to get organizations back in business can have many different forms. I think one of the things that I'd caution is my understanding in this particular case, there are a wide range of situations that an organization might be in with a wide range of recovery procedures. The one that you're outlining, it's certainly plausible that it's one of the scenarios. But what I would say is, we as an industry will learn from this. We always do. If I reflect back to WannaCry back in 2017, coming out of that, we changed the way that we secured our networks. We changed the way that we secured our environments, and we learned. Back into the 90s when we had some of the big worms, we learned. So it's going to happen again. I'd really stress that cybersecurity defense is a very different industry than most other technology in that bad actors are innovating every single day, creating new attacks every single day, and making it such that in order to defend environments, whether it's McAfee defending consumers or CrowdStrike defending enterprises, requires a very rapid deployment of new technology to stay one step ahead of those bad actors. Right. So, while we're going to absolutely learn from this, I do think it's important that part of it is due to the nature of the business.
So basically, get used to it is kind of what you're telling us, Steve. And I'm wondering whether this, as Clara Shai just told us of Salesforce AI, this is inevitable. How often is this going to happen to us?
Yeah, I don't know that I would say it's inevitable. I do think that there are some unique characteristics. I'd put it this way. If we're going to drive cars at 70 miles per hour on roads, we know that people are going to get injured, and that doesn't mean that we shouldn't focus on auto safety. I think we're in the exact same world here. There are technologies like AI that bad actors are using to create more and more lethal attacks, and the cyber defense industry is going to rapidly be releasing new capabilities to mitigate those. Part of that means we're moving very quickly, and we need to learn how to do that with the minimal risk possible of introducing technology defects that cause the issue that we saw, like that we saw today.
Yeah.
But I'd be careful to predict that this is inevitable.
Okay, then how could we have done this differently? What do you think will the learnings ultimately be about how, with speed, you can update and better security without taking down global industry?
So even if you're moving fast, it doesn't mean that you need to do everything all at once. So when organizations roll out protection, doing it in a phased fashion, I know that that's generally the best known practice, but some of the underlying details of exactly how that's done, those are things that the industry is going to learn, polish, create some new procedures. I do think it's important that we don't overreact to this, where if we start putting too many controls on the ability to rapidly mitigate defenses and attacks, we could be in a much worse situation. So on a positive side, we understand this issue very well. We understand the guidance that organizations can have to get back in business. And we also understand even some of the residual impacts. One of the things that McAfee is seeing is scammers are taking advantage of the news cycle to try to scam consumers. We're getting calls into our help center where we're getting reports that our customers are getting reports from people pretending to be their bank, trying to trick them into giving them a password or other sensitive data. Mm-hmm. So it's even those angles that we need to educate the world that in a complex digital world, we really need to be on our guard across the spectrum of enterprise and consumer.
Steve, great perspective. Hands-on approach, Steve Roman. We thank you, Executive Vice President and Chief Technology Officer over at McAfee. Meanwhile, coming up, we're going to be joined by Lizzie Francis, partner at M13, for a discussion on artificial intelligence impact on the future of streaming, on content creation. We're digging into that Netflix angle a little bit more. This is Bloomberg Technology.
I think that AI is going to generate a great set of creator tools, a great way for creators to tell better stories. And one thing that's sure, if you look back over 100 years of entertainment, you can see how great technology and great entertainment work hand in hand to build great big businesses.
Generative AI with the Netflix co-CEO Ted Sarandos there as his take on how it's changing up the industry, the streaming industry. Lots to discuss there. So let's bring in Lizzie Francis, partner at M13 for more. And Lizzie, I'm pretty sure you've been focused plenty on how content is being disrupted, the innovations, and how does your portfolio companies reflect that? Where do you think AI is going to make the biggest difference?
Oh, well, good morning, and thank you so much for having me on today. Yeah, at M13, we really think and see that this paradigm shift with AI is happening today. And it's happening quickly and with great speed. And so what we're seeing is that it's focused mostly on productivity and how we can actually see productivity improvements across all sectors. So we've taken an approach where we are investing in areas that are really changing underlying infrastructure in phenomenal ways. We recently invested in a company called Maven AGI, which is now servicing over 90% of inbound customer service for companies like TripAdvisor and Row. And what's remarkable about this is it's not just the productivity, but as M13 thinks about the future of AI, it's really about this paradigm shift of customer personalization, really thinking about how we can think about creating a better customer experience time and time again. So what you see with someone like Maven AGI is that it really is not just about that passive customer service, which is remarkable in itself. It's also about creating these surprise and delight moments for customers. It's surprising them in places like banking with, "Hi, how can I help you today?" Not just on losing your debit card, but do you need help finding a loan, right? Or is it, how can I schedule a new flight today given everything that's happening as we're seeing? So I think we'll start to see this shift in AI over the next 10 years where it's not just about productivity, but again, it's really about this deep focus on personalization and consumer experience.
So Lizzie, M13 still has to make sort of discerning calculations on where to put money. $400 million fund 3, that's sizable. Is there a high volume opportunity or is it competitive? Like mechanically, everything you've just told us, how do you put that into practice each day?
Yeah, it's a thoughtful point, Ed. And I think because we're at this paradigm shift, one of the things we're most excited about, as we've seen in other cycles, is that there is quite a bit of venture dollars actually flowing into the ecosystem now to propel this kind of innovation. So we're seeing that reflected in where venture dollars are actually being allocated. If you look holistically across the board, about 50% of VC dollars are going to AI and AI companies. And so when we think about where do we want to actually put our dollars when it comes to AI, we still think about sound business fundamentals. And so across the 4 areas that we invest in, health, money, finance, and consumer, what really matters at the end of the day is that when it comes to a company that's either powered by AI or is AI native, there has to be those sound business fundamentals that really drive the business and create a compelling venture-backable business for us to be excited about. And we're seeing them. I think you're right that it is a competitive market out there, but because we're seeing that people are able to innovate so quickly with AI and leverage this technology in exciting ways, we're actually seeing what we'd hoped AI would actually do at core, which is unlock creativity, unlock innovation, and give entrepreneurs the power to actually build businesses that are exciting and transformative. We actually have invested on the healthcare side in a company called Caregnostics, which is actually helping doctors and clinicians diagnose ahead of time previously undiagnosed chronic conditions in patients. Now you can see that doctors and clinicians can actually provide better patient care and think about the actual patient experience.
Lizzie Francis, partner at M13, thank you very much. Now coming up on Bloomberg Technology, more of that conversation with Meta CEO Mark Zuckerberg on the circuit with Emily Chang. Remember, full interview to come July 23rd, but a little nice spicy bit of it right now. Stay with us. This is Bloomberg Technology.